Before a mortgage approval feels real, one ratio usually does a lot of quiet work in the background: debt to income, or DTI. Think of it as the lender's first cash flow scan. It does not judge your whole financial life, and it is not your credit score. It simply asks, after the debts that must be paid each month, how much room is left for the new home payment? Here is the clean version. DTI is total monthly debt payments divided by gross monthly income. Gross income means income before taxes and deductions. CFPB gives a simple example: $2,000 in monthly debt divided by $6,000 in gross monthly income equals 33%. That number becomes a planning signal, not a bragging number. So what actually counts in the debt side? Start with the proposed housing payment: principal, interest, taxes, insurance, mortgage insurance if it applies, and HOA dues when there are dues. Then add recurring obligations: credit card minimum payments, auto loans, student loans, personal loans, leases, and support obligations that underwriting must count. The key idea is simple: use required monthly payments, not guesses. The income side has a different rule: it has to be documented, stable, and eligible for the loan program. Salary is usually straightforward. Bonus, commission, overtime, self-employment income, rental income, and part-time income may need history, averaging, and documentation. This is why a real pre-approval asks for paperwork instead of just taking the biggest number on a pay stub. Now watch the math. If monthly debt is $2,000, and gross monthly income is $6,000, the ratio is 33%. If a new car payment appears, or a credit card minimum rises, the ratio can jump. If eligible income is documented correctly, the ratio can improve. Small monthly changes can move the approval picture more than buyers expect. There is no single magic DTI for every borrower. CFPB notes that loan products and lenders can have different DTI limits. Fannie Mae's guide says manually underwritten conventional files commonly start with a 36% maximum, can go up to 45% with required strengths, and desktop underwriter case files may allow up to 50%. Government and portfolio programs can work differently. This is where compensating factors matter. A higher DTI is not automatically a denial, but it usually needs a stronger story: better credit, more reserves, lower loan-to-value, stable income, or an automated approval finding. A lower DTI is not automatically perfect either. Underwriting still looks at assets, employment, credit history, property details, and whether the full file makes sense. Pre-approval can change before final approval. Updated credit, refreshed balances, a new loan, a different tax estimate, or a revised insurance quote can all move the ratio. That is why the quiet rule is: do not open new debt, do not make large financed purchases, and keep your documents current until the loan closes. To improve DTI, focus on monthly impact. Paying down revolving balances can reduce required minimums. Avoiding new installment debt protects your room. Documenting eligible income correctly may help. And when comparing offers, keep the same assumptions: term, down payment, taxes, insurance, and mortgage insurance. Otherwise, you are comparing noise. Use DTI as a comfort tool, not just an approval tool. The goal is not to stretch to the highest payment a system will accept. The goal is to choose a monthly payment that leaves space for real life, savings, repairs, groceries, emergencies, and the reasons you wanted the home in the first place. Know your ratio. Protect your payment room. Buy with clarity. Rateshive. Learn more at rateshive.com, and follow Rateshive for more mortgage clarity. Subscribe for mortgage clarity, and hit the bell for new Rateshive updates.